Hi, folks. It's Dr. Jeff Camarda with another in the continuing installments of our expectations and review for economic and markets forecast. This one entitled Where the U.S. Economy is Headed. Now, there's no mistaking that the U.S. economy is on a tear. Nearly a decade of economic stimulus and really cheap money have driven the economy to a go-go pace not seen since at least the 1960s. And the afterburners of big tax and regulation cuts and federal spending increases have nearly launched it into orbit. And let's remember that interest rates still, while they're rising, which is going to be toxic to bondholders, they're still really, really cheap by historical standards and probably will remain that way for at least a year or two at least. Unemployment is at a half-century low, and sooner or later, this cycle is going to reverse. It always does, and we will enter recession. Martin Feldstein, the Harvard professor, recently wrote that higher rates will drag down stock prices and household wealth, cooling consumer spending, and possibly tipping the economy into recession. He noted that the 10-year rate, which again is still low by historical standards, is more than double where it was just 2 years ago, and will be pushed even higher for at least the next 2 years as inflation kicks in, possibly to the 5% range or beyond. Now, already higher rates are cooling household and auto sales, and these higher rates, the Harvard professor suspects, will drive U.S. stock prices down closer to historic pricing levels, some 40% lower in some cases for really inflated, overvalued stocks, like maybe some of the tech stocks, than current levels in his view. So he's predicting the stock market, mega bear market, really. I'm not quite so pessimistic, but we certainly both agree that U.S. stocks are vastly overvalued, many of them, especially given current conditions and rising interest rates. He thinks such a correction of stock prices from where they are to where they should be on a fair pricing basis could prompt a recession that might be deeper and longer than is typical. Now, it's important to put the term stock prices in context, since for many investors, they come to have a life of their own, disconnected from the earning power of the companies, which is what they really represent. So we should never forget that we're buying pieces of companies for their ability to produce profits. So when we talk about U.S. stocks being priced higher than historical levels, we mean that we're paying more for a share of earnings than we probably should. To use rental housing as an example, suppose we have two houses, both producing net rent after expenses of $10,000 a year. If we can get one house for $100,000, we net 10%, pretty good. If the other house costs $400,000, we only make 2.5%, meaning we lose money after taxes and inflation. Both houses look great, but you have to appreciate the economic utility of the asset, and hopefully this example was illustrative in terms of stock prices. Unless we consider the earning power of the house and how it relates to price, we might just consider that the more expensive house keeps going up and assume this will continue forever, which is a kind of a hardwired human mental tendency, by the way, to extrapolate trends. But of course it won't. This is where the term correction comes from, where stock prices correct to a more appropriate relation to the earning power of the companies they represent. By this measure, most, certainly not all, not the sort of stocks that we hunt for in our individual stock portfolios and the mutual funds we use, but most U.S. stocks are overvalued and probably primed for a correction, which could even tip stocks into a bear market. And that's enough gloom and doom from Dr. Jeff Camarda here today. Thank you so much for watching. Until next time, and our next installment will be investment strategy for 2019 and beyond. Until next time, thanks for watching.